Blockchain Show is a podcast that demystifies cryptocurrencies and distributed ledger technology.
Hello and welcome back. My name is Ethan Kinderconnect and you're listening to The Blockchain Show. It's a really great honor and pleasure. Today I'm speaking with Evan Kuo, CEO and co-founder of Ampleforth. Welcome, Evan. Thanks for being here.
Yeah, thanks for having me, Ethan. I'm always happy to kind of share my journey of how I got to Ampleforth and what we see coming around the corner.
Yeah, well, again, it's my pleasure. You know, you guys are doing some really cool things. So why don't you just tell us a little bit about yourself and how you got to be in the position you're at, if you don't mind.
Well, I grew up in the Bay Area, kind of near the Cupertino, Los Altos area. Went to college at UC Berkeley to study mechanical engineering. Got really into computer science along the way and increasingly transitioned my focus in that direction towards kind of robotics. And then after graduating, I got kind of pulled a bit into the startup world. And I think I was working at one of these startups and one of my coworkers first mentioned Bitcoin to me very early on. So this is around the time where there was just a paper and mining had just begun. I remember thinking about it. I read the paper. I just remember thinking, this is never going to work. And I thought it was never going to work because it was so unscalable, number one, which I was just like, why would somebody design a system that was so unscalable? And, number two, I was like, well, it's got a fixed supply. Haven't we already kind of, tried that? Like, wasn't there this gold standard and Bretton Woods and so on and so forth? Those are thoughts that I had. But the real reason I was worried that it wasn't going to work, and I was like, okay, it's just because it was too complicated for people to kind of just reason with. Just the idea of a digital gold or a new internet cash seemed so out there. There wasn't really anything you could buy with it. There was no real place to exchange it. And I was like, this is a really big and cool idea, but like the odds of this working out, I would pin them very low. And then just kind of went back to, life in tech and kind of, wasn't thinking too much about Bitcoin, except for from time to time I would check in on it. I guess like stepping back from that, the wheels kept spinning in my head a little bit, right? So those questions, like, why would you design a system so unscalable? I mean, eventually kind of that question was kind of answered for me. It was like, well, they sacrificed this technical scalability for social scalability, right? It needed to be censorship resistant because in the past, anytime, an independent party tried to create money, it became regulated and they were told not to do so. So that was answer number one. And second thing that stuck out to me is like, well, this whole fixed supply thing, that's interesting. They're able to create something that's really scarce in a purely digital context. And, most digital things really aren't that scarce, right? It's a file that gets uploaded. It's an image. It gets copied and pasted a million times before it even shows up on your computer. It's replicated by CDNs all over the world. There's no scarcity, but the Bitcoin protocol was able to create scarcity through its kind of, universal ledger. And then I kind of, forgot about it again until Ethereum came out. That was more of an overt invitation, right, to participate because it's this open platform, right, almost Turing complete. You can just write code and contracts with it like engineers are accustomed to. Sometime shortly after, I started kind of just talking about blockchain technology and smart contract programming platforms, Bitcoin and Ethereum, with my would-be co-founder, Brandon Iles, who I think he was at Google at the time and then eventually went to Uber. One of the central questions behind like our conversations was like, well, what is the real application of this, right? Why people were going crazy at some point. Like this is 2017. We saw these like, crowd sales, just rooms packed with, demand for services that didn't really, make sense to us. Like I remember a specific conversation, we were talking about this thing called storage. It's kind of this like, decentralized file storage application. And we were just like, well, would anyone want to use that instead of like Amazon? What is the function of the token, right? How does it capture the value from, demand for it as a service? And why does this make any sense? Like, why are people buying this? Like, how does it fit into this broader context of a new world that we're creating? And we really, really, thought really hard about it and kind of came to the conclusion that it doesn't fully make sense. We really came back to this realization that, the core features that have been enabled by the blockchain are censorship resistance and digital scarcity. And one clear application of that is innovation in money and in finance. And, then we kind of, we raised around a small seed round from True Ventures, Brian Armstrong, Founder Collective, Pantera, had some good friends there. Brandon was friends with Brian. And, what we wanted to do was we wanted to create this, like an algorithmic stablecoin that was, collateralized by all this stuff. And we had an initial design that had this kind of algorithmic reserve, not unlike some of the stuff you see today. But we really kind of put it through the ringer, at least on paper. We kind of imagined, what kind of situations it could survive and what kind of situations it couldn't survive. And along the way, we also kind of got connected to these academic advisors at the Hoover Institute at Stanford, which is a political and economic think tank. And they really helped us answer some questions because we knew that, an algorithmic stablecoin was a big deal, right? That Bitcoin couldn't be used for a lot of things. It couldn't be used as a unit of account. It could be used as, just a commonly accepted medium of exchange because it was just too price volatile. And we knew that, like, in order to create this kind of alternative financial ecosystem, that something new needed to be created that could fulfill those functions. But we also wanted to create something that was durable and kind of unbreakable the way Bitcoin was. And I remember, after meeting Manny and Neil at the Hoover Institute, sharing kind of our initial designs with them and had this, complex fractional algorithmic bond-driven reserve. And they hated it. They were just like, well, this looks like you've attempted to create a decentralized central bank, except you don't have kind of, the money printing authority to bail out this bond ecosystem. And we were like, yeah, that's true, right? There's a reason why these sovereign monopolies work and these kind of systems work well in those conditions. It's because they can force you to use their asset as a unit of account. They can print, and we can't, not as an independent monetary system. And so we started to strip things away. And we said, like, okay, well, how do we make something that's more advanced than Bitcoin, right? That can fulfill more functions of money than Bitcoin, but is extremely durable. And so we got rid of the balance sheet. And what we were left with is Ample, AMPL, which is actually a very simple token. It's a decentralized unit of account. And what makes it different from Bitcoin and floating price tokens is that it has an automatic supply policy that increases or decreases the quantity of Ample tokens in user wallets based on price exchange rate. So basically, its price targets the 2019 dollar. And when the price exchange rate of Ample is greater than that, everybody gets proportionally more Ample tokens, which brings price down. And then when the price exchange rate is less than that, everybody gets fewer Ample tokens, proportionally fewer Ample tokens, which restores price upward. And what this protocol has the effect of doing, and I can say this with confidence now that we have 2.5 years of live data, is it has the effect of separating Ample's price volatility distribution from its stock volatility distribution. So the price volatility distribution of Ample is mean reverting. So its price kind of just always is normally distributed around the target, which is very uncommon for typical non-collateralized cryptocurrencies. But its stock volatility, this is its supply volatility, is fat-tailed, which is similar to like Bitcoin and equities and other cryptocurrencies. And so, really the secret of Ample's durability is that it transfers the volatility demand from price to supply rather than trying to eliminate volatility altogether. It's kind of like a judo move, right? So rather than trying to eliminate volatility, it just transfers the volatility. And what this allows you to do is allows you to denominate, basic contracts using Ample. And that's a really powerful thing because DeFi is all about contracts, and right now we're building increasingly complex kind of contracts and banking systems with the assumption that these stable coins are going to endure or be allowed to exist. And so with Ample, you really have the first building block here that allows for contract denomination that doesn't rely on centralized custodians or bailouts. It's kind of already proven that it can survive a secular increase in demand and survive a secular decrease in demand. And so with that, I'll kind of pass it back to you, Ethan, to see if I kind of talked for a long time. I want to know whether you had any questions.
Oh, that was great. In visiting the Bay Area last spring, it was really fun. I love it up there. I often wonder what it would be like to grow up there because, I'm living down Los Angeles area, and there's some, they got Silicon Beach, but you really have to seek out the blockchain groups, when they were still meeting regularly. And, as a kid growing up, my kids are growing up here. I wonder, it's like, it's entertainment, largely like movies, music, but being up around, San Francisco and Berkeley, my friend was driving me around and seeing the tech giant facilities. And I was like, man, I wonder what that would be like for a kid who has an interest in technology, just the opportunities there and the conversations you have. And
totally. Yeah. I mean, look, I live in LA now, actually, as of this year, but yeah, we should meet up if you're around. But it was very different growing up in the Bay Area. I guess I kind of grew up in this kind of .com era too. There's a lot of influence there, a lot of entrepreneurs, a lot of technology. We were taught programming. I think, my first exposure to programming was this kind of thing called HyperCard. We had a little computer lab and probably writing basic programs, maybe in the second grade or something. It was more interactive. It was kind of like creating a PowerPoint presentation, but you could write little scripts and have it do interesting things like play video files and, animate things, transition. And quickly after that, it was just basic programming. And then, programming your calculator. There was a lot of programming influence, but I also, ended up going to the same high school that Steve Jobs went to and Steve Wozniak went to. So it's Homestead High School in Cupertino. And so I guess the legacy of kids running around playing with electronics and then one day building businesses, was, I guess all over. I even remember driving on or getting a ride really as a kid on Highway 85. And, we would see the massive Think Different poster on the side of the Apple campus. That was just like the iconic Apple campaign. And then having gone to Berkeley, being exposed to venture capital afterwards, it's a lot. There's a lot of infrastructure there for supporting innovation. And it's really important. Like one of the things that's great about the Silicon Valley is you can be a starving entrepreneur with dignity, right? So I would say in other places, if you're like, hey, mom and dad, I quit my job and I'm going to try to, borrow money, raise some money, start a business, pursue my dream. People might be like, yeah, good luck with that. But I think in the Bay Area, you can do that. You can take a pay cut and there's enough of this support network. And there are enough kind of success cases of people actually, making it or failing and then failing into a better position in life that you don't feel so crappy around coworkers or former coworkers who are making a lot of money at, the Googles and Facebooks of the world. So it's an important infrastructure for taking kind of big risks and thinking really long term. But for my part, I guess the way I would synthesize it is I've always wanted to just create something to encode some set of values into something that could live well beyond myself. And that was what was extra appealing about blockchain and Bitcoin. For sure, I remember thinking that, this is a digital gold. And at first I thought that was this sucks because what we really want is a digital cash or a digital dollar. And then I remember thinking, actually, this is really cool. We've been able to create digital dollars, so to speak, most of kind of the dollars that were circulating after the Nixon era, after kind of Bretton Woods. Most of it is digital anyways, right? It's a banking system. It's a complex accounting system, but we've never been able to create gold. That's something that, is old school. Like Isaac Newton toiled away at that, right? Generations of alchemists and mysticism, and gold is this kind of natural commodity. It's something that you don't think of as something that a human being can create. And when that clicked for me, it's like, wow, the Bitcoin protocol has succeeded in creating a man-made gold. I was like, wow, that's actually really lasting, right? That lasts a lot longer than, my iPhone, right? Or, any line of code that I've ever written at a big organization, or any line of code that Brandon's ever written at a big organization. All that just gets overwritten, updated, thrown away. But there's something about the blockchain technology that actually is very lasting. And so I guess that's a piece of the puzzle too. We definitely valued that. And we were able, I guess, earlier than our peers, to see what was special about commodity monies, how they fit into kind of a financial context, how they endure. And we were able to kind of integrate that with what we were being exposed to through these like experts at the Hoover Institute. Yeah, when we created Ample, it's like, how can we make a commodity money that's better than gold? And it's like, cool, let's make a commodity money that could be used in contracts. And from there, we can build much more interesting things. And so, cutting to today, we took this concept of a building block that people got pretty excited about like a year ago. And now it's actually being used as a building block. So the first example is like Ample on Aave. So Aave, for those that aren't familiar, is the largest DeFi bank. And it allows you to kind of lend and borrow cryptocurrencies. But you don't really want to take out a great deal of debt that's denominated in a price volatile cryptocurrency like ETH. You don't want to like borrow 1,000 ETH and then discover that ETH doubled in value and be on the hook for paying back a lot more than you thought you were going to need to pay back. You want to kind of take out loans that are denominated in something that's reasonably price stable. And so today, the majority of the lending, it takes place in USDC or DAI, right? So USDC, for those of you who are unaware, is just kind of like a dollar collateralized coin, right? So it's actually really just the traditional finance system. And so really, it's kind of like the secret sauce to decentralized finance is ironically just traditional finance today. And then the other kind of big alternative to that we see with lending and borrowing is DAI, right? Which, due to a massive collapse, on Black Thursday, was originally collateralized mostly by ETH, but now it's really mostly collateralized by USDC, which is mostly collateralized by dollars. So it's this great irony that all this innovation is taking place, and it's still dependent on just traditional dollars. And so that's why it was kind of a big deal to have Ample available as a lend and borrow asset on Aave, because now you can actually take out loans with a purely algorithmic, durable coin. And that's what makes it an interesting building block. It's a unit of account. And I'm even more excited about what's to happen after this simple kind of lending, borrowing phase, because this unit of account can actually be used to create derivatives as well. And that's going to be really important, in my opinion, moving forward.
Yeah. Wow. There's a lot of interesting things there. For a lot of folks listening, their introduction to cryptocurrencies comes from, exchanges like Coinbase or, I don't know, crypto.com or something like that. And it's kind of harder to get some coins. Like I know to get Ample, you have to go through the Coinbase wallet. And I decided, I want to start getting some skin in the game. So I've just been slowly collecting small amounts of tokens, but they're just kind of residing in these wallets with the hope of one day I can actually, utilize it. I'd like to be able to get involved with DeFi. But for kind of like the everyday listener who might be getting into this space, I know you mentioned Aave, but, what are some of the ways that they can get involved aside from just, exchanges?
Yeah, so with these kind of really on-chain native assets like Ample, they actually just work out of the box for a lot of decentralized exchanges like Uniswap. You can get Ample there. You can get Ample on KuCoin or Bitfinex, and then you can kind of start to participate in it. You can borrow and lend it on Aave. You can create a liquidity pool on Uniswap. You can participate in staking programs. It's a little bit more advanced, I think, than just buying and holding a coin. But I mean, these are kind of the early adopting active people that matter so much. But for those of you that do just simply want to buy and hold a coin, this is something that has been really difficult for us because although Ample works perfectly in a decentralized environment, it ironically needs a special integration in some of these centralized environments. And part of that problem is going to be solved by this thing called WAMPL, which is a wrapped Ample. So you can just take this unit of account, Ample, deposit into a contract, and it turns into a vanilla token that's like every other token. And that is one of the ways that it can be made really easy to integrate with some of these more centralized systems. And so that actually is right around the corner. And in some cases, people will be using WAMPL like underneath the hood without even knowing it. And in some cases, they'll be interacting with this whole wrapped Ample directly. And so yeah, it's about to get a lot more easy to access Ample. So this is one of the disadvantages of thinking a little bit too long term is you end up building something that there is no infrastructure ready for, and then you have to kind of interface with the old infrastructure or ask the old infrastructure to evolve. And so luckily, some exchanges have evolved to just naturally support Ample. But for those who haven't, there will be a wrapped version of it, just like there's a wrapped Bitcoin that allows you to kind of use Bitcoin in ERC20 native contracts. There'll be a wrapped Ample that allows folks to access it through popular exchanges coming soon. So that's exciting for me.
Yeah, it's fascinating to see how things are evolving. Yeah, I wanted to ask you about a Black Thursday event you mentioned because I did get some DAI and some USDC because I really do like the idea of staking. So I got a little bit of each, and it's kind of, it's interesting to see that you can stake those tokens at a lower yield, but then it kind of hit me like, am I just clinging on to the past? Like this is tied to the US dollar, and what has the dollar been doing lately with, inflation? And is that a good thing to kind of anchor my savings to? I don't really know. So I really do like the concept of, having a fully algorithmic unit of account that, it seems like it can kind of like adjust itself automatically. So I was going to ask you, if you could maybe explain a little bit just how that works. Is it just once you write the code, you just kind of monitor it to make sure it's working, or do you ever have to go in and, make adjustments to make sure it's working correctly?
Yeah, that's a good question. So it is kind of novel that we can increase and decrease the supply of Ample and user wallets without a transaction between peers. And the way this works is every single day it receives kind of a volume weighted average price exchange rate. And like I said, if it's greater than 1, we proportionally increase the number of units in user wallets. If it's less than 1, we proportionally decrease the number of units in user wallets. And by we, I mean the protocol kind of automatically does this. But the way it does it is it updates this global coefficient of expansion, so to speak. So you can kind of think of it as like a constant, right? Imagine there's a gravitational constant, and the planets are a certain distance apart from one another. And if you increase the value of that constant, the planets get closer. If you decrease it, the planets get farther. It's kind of more similar to that. So rather than requiring me, Alice, to transfer X tokens to you, Bob, and requiring you, Bob, to transfer Y tokens to me, Alice, in the event of expansion and contraction, what really happens is we're taking this price exchange rate information and we're representing it in the form of a scalar coefficient of expansion, which reflects itself in a change in the balance of units across all user wallets. And this is kind of something that could only be done with a smart contract programming platform like Ethereum. It's kind of, I guess, the closest analogy in real life is wheat, right? People think of wheat as a natural commodity, but it's a commodity money as well. When there's a really good rain season, imagine like everybody gets more wheat. It's more kind of fruitful crop. And if there's a bad weather season or there's locusts or some infestation, there's like less wheat, right? The supply of wheat, if you own kind of a farm, right, can increase or decrease based on environmental conditions. Now that's not really in itself very helpful, right? Because sometimes, what you actually need to support an economy is more supply, and sometimes what you need is less supply. It has nothing to do with the weather. But if the supply could increase or decrease directly in response to demand, then you have something that economists had only dreamed of for a very long time. So, I mean, Buchanan wrote about this, Friedman wrote about this. There was a lot of really good thinking about what an ideal base money might look like around the time of the end of Bretton Woods, right? So under Bretton Woods, we had dollars that were redeemable for gold by foreign banks, and central banks and foreign governments could redeem their dollars for gold. It was, in a sense, kind of pegged. And that was really good for keeping inflation in check. But it was really bad because the dollar, was supplying the world's economy, right? There was a lot of dollar demand, not just by the US, but by the world at large. And at some point, it became impossible to hoard enough gold to supply the dollars necessary for this global economy to function. And that resulted in this kind of price increase for gold, which made it even harder for, the system to release additional gold, and made it harder for the system to kind of support the economy. And that's one of those situations that you just kind of call a deflationary spiral. And so at some point, Nixon had to just take us off that redeemability standard, because if he didn't, then the entire economy could grind to a halt. That's kind of the danger of using a fixed supply commodity money as the basis of monetary standard. And so around that time, a lot of economists were like, well, we could just let this thing float, create a fiat money that's, completely discretionary, where, central bankers could just increase it at will or be pressured to increase it. We could bail ourselves out. We could bail others out. We could stimulate. That would make it really flexible, but really unbounded in its kind of potential for inflation, right? So mismanagement, or even well-intentioned kind of management, discretionary policymaking, could still be vulnerable to inflation, as we see today. And so, those folks were always wondering, well, what would have been a better gold? What would an ideal base money, if not gold, what would this ideal base money look like? And they all kind of came to the same conclusion, which is it would be a rules-based money with a perfectly elastic supply policy. And that's really what Ample is. Like, when we took away all that algorithmic reserve stuff and came back to the Hoover Institute guys with just this simple commodity money that could automatically increase or decrease its supply based on demand, they got really excited about that, which is ironic because, the people in tech were like, we need a stable coin, we need a stable coin, we need a stable coin. And the people in finance were like, or at least people who were knowledgeable about monetary economics were like, we need base money. We need, like, the opportunity you guys have stumbled on here is you can now create things that are much more like a commodity money. Here's a real problem that we've been thinking about for 40, 50 years. And so Ample was highly appealing to them. And it turns out that you can actually use Ample or an Ample derivative to create a stablecoin. So going back to the collapse you were talking about with DAI and Black Thursday, DAI had promised this kind of decentralized, kind of self-sovereign stablecoin that was collateralized by cryptocurrencies, right? Like ETH. It was mostly collateralized by ETH. And when the market took a dive, the way those systems work is they force a certain collateralization ratio. They'll say something like, as long as the value of the ETH in our collateral pool is 150% the amount of dollars circulating that's being represented by this token, then we're safe, right? These dollar coins are going to be redeemable for at least their face value. But then the problem is you're still dealing with this hyper volatile collateral asset ETH. And so what happens when ETH takes a dive and you're under collateralized? The system collapses. And so it's really quite misleading because you're circulating this kind of token that's supposed to represent a dollar, but you're putting the risk of a black swan event in the hands of people who don't know it. And so when that happened, the system kind of collapsed, so to speak, right? They had, emergency governance action, right? They had to get private parties to help bail it out. And ultimately they said, like, look, we can't just have ETH in this reserve. We need to just put USDC in the reserve. And I think that's over 60% of the reserve at this point. So, I mean, it's unfortunate because the ideology was kind of stripped out from underneath them. They just said, like, we're going to have this decentralized crypto dollar and we're going to collateralize it with USDC, which is just collateralized by, traditional assets. But it does mean that they could one day rotate USDC out as collateral if some alternative safe asset could be created. And that's the sort of thing that I think can be done, with an Ample derivative. So you can imagine a really simple contract that says, like, okay, we have this underlying stock volatility of Ample. Let's put 90% of the supply changes. Let's just take this pool of Ample and say, have 90% of the supply changes be reflected by this kind of senior token or junior token, and 10% by the other token. And you'll, at that point, have resegmented the volatility of the underlying asset into tranches, right? It's like saying, imagine the volatility of Bitcoin. Let's create an instrument that is twice as volatile and combine that with an instrument that's half as volatile. The math all adds up, but you've created a leverage instrument and a deleverage instrument. And you can use this deleveraged instrument as an alternative form of safe asset collateral. So I would describe what our peers in this space have been doing as kind of like, I guess, putting the cart before the horse. It's kind of like saying, look, I want to drill in the ground, this is Manny's analogy, but I want to drill in the ground, get some oil, put it in my car and drive it. Really, that's not what's happening. You're drilling in the ground, you're getting petroleum that needs to be kind of refined into kerosene and gasoline. Then you could take the gasoline and put it in your car and drive it. That same kind of refinement process needs to kind of take place in crypto, where we have these raw commodities like Bitcoin or Ample or Ethereum. Now we need to resegment the risk of those underlying commodity-like monies into these tranches, right? And then we can use these tranches for different purposes. We can kind of then do much more with them once we've kind of refined and resegmented the underlying risk of these assets. So I think there's a really big future behind derivatives here.
Yeah, absolutely. Is there any relations to the traditional financial derivatives, or is it just share the same name?
I mean, a derivative is just a special type of financial contract that's connected to an underlying asset, right? And so, like I said, Ample is a unit of account that enables contract denomination, right? And, lending and borrowing is a special type of contract denomination, and derivatives are a special type of contract denomination. But this idea of tranching, right, of segmenting risk into, senior tranches that are low risk and junior tranches that are higher risk, like repackaging an existing risk, is something that has been explored greatly in traditional finance. I would say, however, that it hasn't been as transparent as it would be on chain. So one thing that people think of when they think of, derivatives is like, mortgage-backed securities, right? Like, what are the hidden risks that when I'm taking a bunch of assets and repackaging them and stamping them as low, medium, high risk, and then reselling them and securitizing them and all this stuff. Like, the interesting thing about this kind of DeFi version of it is it has to be transparent. It will all just kind of need to add up, or else, I mean, that's just the way these contracts are. They're all on chain. They're all exposed. So there can't really be that hidden repackaging of risk. I think that's one of the special things about DeFi as well.
Yeah, it's a really fascinating time in history, and I struggle with explaining it to people. I mean, even when somebody just asks me, what is blockchain, I kind of pause for a minute, and I'm like, man, this is like a huge responsibility. It's like kind of like when my kids would ask me, like, what is God?
Yeah. What happens when we die? And you're like, oh my God, I have to do this now.
Exactly. And I mean, that was part of the reason of starting the podcast, was to, talk with experts like yourself, to have something to point people towards, and hopefully inspire and educate and, keep people informed. It's amazing how it's just ever evolving and solving new problems. And it's something that I can, open a web browser and every day be amazed at what's to come. And there's things yet to be addressed that I probably didn't even think was possible. So like I said, it's just a really interesting period of time to live.
You know what I started saying to people that I can stand behind, in terms of like what is blockchain, what is DeFi, what are cryptocurrencies thing? I've come to start saying that cryptocurrencies are just a new generation of digital precious metals. And I've come to start saying that DeFi is a new generation of very simple banks that allow you to kind of trade, lend, borrow these new digital precious metals. And I feel that that's much likely to lead people in the right direction than not. Like, if I went them and said, like, it's a new like, honestly, when I think about it, a lot of it comes back to the title of the Bitcoin paper, right? A peer-to-peer digital cash. If it was called a peer-to-peer digital gold, things would be very different, right? So people could really get behind this idea of an internet money, like a cash, right? That was independent of any one country and purely digital, a peer-to-peer digital cash. That's a very convenient story. But what was actually delivered was a digital gold. And so much of how, the market has evolved has been in negotiating this convenient lie of digital cash and dealing with this inconvenient truth of digital gold. Because people just don't understand gold, but I guess they've come to appreciate this digital gold as a concept. That it's the truth of what's been delivered. And it's actually a huge deal. Like I said, I think it's a bigger accomplishment for man to have succeeded in creating gold than to have succeeded in creating a bank. We already had banks. We never had man-made gold. Now we do. So, yeah, I do think that anytime you say something like magic internet money or digital dollar, one day, I mean, people will start thinking, they'll make the wrong associations, right? Like, we don't use dollars as a check against inflation, right? We don't use it to speculate. We do use gold as a check against inflation. We do use gold to speculate. And guess what? We also use Bitcoin to speculate, and we use it as a check against inflation. You know what we don't use Bitcoin for? Anything that we use the dollar for. We don't use it for goods and services and wages and contracts, or we don't use it as a safe haven, and we don't use it to kind of store near-term value. So everything that's associated with a dollar or cash is exactly the opposite of the use case of a gold. and is also exactly the opposite of a use case of Bitcoin. And so that great and convenient lie, I think, has led to a great deal of confusion. But also, it's much easier to sell.
Yeah. Yeah. So we've drawn a kind of a comparison to Bitcoin, which is probably the most widely known cryptocurrency, and people are familiar with how Bitcoins are created through mining. How, I guess it's kind of a basic question, but how is Ample, brought about into existence? How does a new Ample come about?
Yeah, I mean, it's almost like we had just all the Ample in the universe has already kind of existed. So the moment it was launched, $50 million worth of Ample, I think, or so, released, and it proportionally increases or decreases. So if you own 1% of the Ample network at a $50 million market cap, and let's just say 10x's to 500 million, you'll just have 10 times the number of coins. And so there is this kind of unemitted stock of Ample in an ecosystem fund that we've been systematically distributing to people who participate in liquidity mining. But the way a new Ample gets created is the supply is adjusting every single day based on price exchange rate. So it looks at the demand for Ample that's reflected in its price exchange rate, and either increases everybody's Ample count proportionally or decreases everybody's Ample count proportionally. And so that's, in that way, it's non-dilutive. So the inflation, as it were, in the Ample system doesn't have that dilutive effect. It's not like the US dollar, where like you got $1,000 in your bank account, we're going to print a bunch of it. It's not going to your bank account. It's going, to buy bonds, right? It's going to somewhere else, right? And therefore, the percent of the total money supply that you own is decreasing as kind of inflation takes place, or as money printing takes place. That's not what happens in the Ample network. It's all proportional. So it really is just it's a very simple commodity money, non-dilutive, except it can be used in contracts. And now I really think that's going to be increasingly used in contracts. It's kind of like the Bitcoin of contracts. Maybe I should start saying that. Ample's like the Bitcoin of contracts. Does that work for you?
Yeah, I like that. Yeah. Yeah, because I was kind of like you. I'd heard about Bitcoin from my co-host, and I don't know. It didn't quite click. I was a little apprehensive, but then when we started talking about Ethereum, it just kind of blew my mind wide open, and that's when we just started to start the podcast, and just the idea of smart contracts, and we had really interesting conversations early on, and then the first DAO collapse happened, and it was kind of a big blow, and I thought, man, all right, this is then the Ethereum fork happened, and it's just been kind of like a constant evolution since then. But I really do like the idea of smart contracts, and I think that's pretty much what NFTs are. I mean, correct me if I'm wrong, but it's kind of like it just seemed like a rebranding to me, just to call non-fungible tokens NFTs, and all of a sudden it became very popular. But I mean, when we talk about musicians releasing an album as an NFT, and then basically not needing record companies anymore. Instead of giving away 80%, they get to keep 80%, and then their listeners basically become the I don't know, the record company, for lack of a better term. It just seems like there's so much possibility for these technologies that people who are just buying and coins and trying to sell them at a higher price are kind of missing the point. And I can see why people, it's attractive to them, because that's what they've known from like stocks and maybe precious metals. But we're really getting into an era where this is it's life changing for a lot of people. And my hope is to I don't really have the ability to I just don't really have the money to put up enough to make a liquidity pool worthwhile. I mean, I don't know, maybe you could tell me otherwise, but it just seems like you have to have a certain amount of tokens to really.
Yeah, you know what? I don't think there really is a minimum. Um, I mean, you could just, and now it might not be worth your time, and maybe at some level the gas cost of creating an LP pool is higher than what you could benefit from in terms of fees. But I do think that people can start in a much smaller way than they ever thought before. To your point about NFTs, look, I think we're in the middle of an asset class boom. And as a result, this is a great way for folks to raise capital. And that includes musicians, right, who have had a much harder time raising capital than people in the tech world, right? And if they can do it by selling digital collectibles to their fans, right, then they can have a career, and they can continue to do the great work that they do. And if their fans are buying these collectibles because they think they'll go up in value because we're in the middle of an asset price boom, good for them, right? That's part of it. The speculation, I don't think, is entirely the enemy. I think it bootstraps certain things. And the question is, like, what things of lasting value can be bootstrapped by folks who are in crypto because they want to get rich quick? And in the case of Bitcoin, it bootstrapped the liquidity of a digital gold, which has a very clear macroeconomic function, right, to check against boom and bust cycles and check against inflation. And as some of these more advanced commodity monies start to emerge, like Ample, right, speculative interest in it will bootstrap the liquidity of an ideal base money that can be used as the basis of, like, a new financial ecosystem that stands on contract denomination. And so sometimes the speculation leads to nothing. In fact, often it does. And sometimes the speculation can actually be an important piece of the puzzle. I think if Bitcoin did not have any speculative interest, we wouldn't have such a liquid Bitcoin market today. And then it wouldn't be this great way of storing and transferring wealth and value. And it just, even if it was conceptually a digital gold, it wouldn't be a digital gold in practice. And so I think, it's about getting the intellectual economic design of what you're creating, right from the beginning. And then from there, it's about creating this kind of common understanding of value. It's not just about a common understanding, right? People always use this analogy of seashells. If you could convince everybody in the world that seashells are the best money, well, you'd still have this thing that's disintegrating in your pocket at some point and be like, this is just impractical. Practical gold is better. It's more durable. So there's that moment where the rubber meets the road. That's like the practical reality, right? That's like what crumbles and crushes in your hand, seashells or gold. It's a practical reality. And then there's the place where the road meets the sky, and that's, education, communicating a vision, creating a community. And so many people today are living in this area and thriving and making money in this area where the road meets the sky. They haven't thought about whether, what's being created actually is going to last or make any sort of sense in the long run. And that's okay too. You can, it's an open environment. People can kind of try all sorts of things, but we really did care about the lasting impact of what we were doing. And it's clear that, the creators of Bitcoin cared as well.
Yeah, I like that. That's a really good way to kind of reframe things. That's one of the beautiful things about cryptocurrencies is you don't have to buy a whole token. You can buy a fraction and start small. Yeah, man. Well, I know you got to get going. I just want to say thank you for the conversation. I learned a lot, and thanks for sharing all this with us. Definitely interested to see where Ampleforth goes in the future. Plan to get much more involved, and yeah, man. If there's anything you want to leave us with, or where people can go to learn more or get involved, please feel free.
Yeah, just check out ampleforth.org. There's some good resources there, and we'll be in touch. Thanks, Ethan. Really appreciate you taking the time.
It's been a real pleasure. Thank you.